We're going to explore two S&P 500 sectors with lower stock market risk. So stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. With the threat of higher interest rates, the high-flying tech stocks of 2021 are seeing a drop as much as 12 to 15% year to date, with many individual stocks dropping much more than that. If you're an investor looking for ways to have lower risk in your portfolio, we're going to look at two S&P 500 sectors here today that have lower risk. Here's a headline: Citi forecasts Federal Reserve to raise rates by 50 basis points in March. We're looking at two commonly used technology ETF index funds, the QQQ and the XLK. Year to date, the QQQ is down 15% and the XLK technology stocks are down 12.5%. So you might be saying, I sure enjoyed it on the way up, but I'm not so sure that I want to take the punishment on the way down. Let's take a look at what inflation and higher interest rate can do to stocks. Investors start to rotate money to stocks that benefit from higher interest rates. Tech companies' cost of borrowing money increases, and this may decrease profits. Now, there is a way to measure a stock's volatility, and that's called the beta. It's a measure of stock's volatility in relation to the overall market. If a stock moves less than the market, the stock beta is less than 1.0. High beta stocks are supposed to be riskier but provide higher return potential. Low beta stocks pose less risk but also lower returns. Now, for example here, S&P 500, the beta is 1.0. The S&P 500 is used as a market barometer for beta. It has 1.0. So if you're investing in a fund that has a beta higher than 1.0, it's more risky. If you have a beta of less than 1.0, it's less risky. Here's the formula for beta, and I'm sorry to say we don't have time to go into this today. We're looking at the 11 sectors for the S&P 500. Now, you might be surprised to learn this, but the S&P 500 is made up of 25% technology stock. And we just said that the technology stock are taking the brunt of the selling right now. So this is why you may want to look at ways to reduce some of your exposure. The first sector we want to look at here is the XLP consumer staples sector. This has a beta of 0.64. A minute ago, we said if your beta is less than 1, you have less risk. Here's the top 10 stocks in the XLP consumer staples sector. And you can also see the weighting here in the second column here. But all of these stocks, well-known blue chip stock. Consumer staples stocks sell products that we need at all times. For example, we all need to brush our teeth. Colgate-Palmolive is one of the top 10 stocks. You can see the last 3 years, consumer staples were up 14.76. It's not going to be like the high-flying tech stocks. And then on the downside, year to date, it's down 2.41%, which is not even close to where the tech stocks are on the downside. So the second area here is the XLV healthcare sector. You can see the beta is 0.73. It's less than 1. Return last 3 years, 15.76%. It's down 7.55% year to date. Here's the top 10 stocks in the healthcare sector. And then the second column here is the weighting of each individual stock in the sector. Now you might be asking, can I invest in each one of these individual sectors? You can purchase each one of these sectors individually. There's 11 sectors in the S&P 500, and these are two of the sectors here that you can purchase individually. Here's two more sectors in the S&P 500 that have betas less than 1. This is the utility sectors at 0.48 and the real estate sector at 0.77. Now, when we think of investing in these sectors, we also have to think about where is money flowing. We just mentioned the real estate sector that had a low beta, but with rates rising, money may be flowing out of real estate into other areas. Here's a look at some of the other sectors. Now, all of these have betas greater than 1. And we can see here the technology sector here had a beta of 1.05. I mentioned the 34% return last 3 years, but it's down 10.92% year to date 2022. Now, interesting, the energy sector does have a high beta, and it's up 26% year to date in 2022. Now, we mentioned invest where money's going. If we look at the XLF financial sector, It does have a beta of 1.23, but with interest rates rising, the financial sector can benefit from that, and it's only down 2.7% year to date. So the goal here is to reduce your downside risk, but you still want to be in the market because the market still has the potential to go higher. We're looking here at a chart of the S&P 500 total returns during Fed hiking cycles since 1954. You can see here back in the 80s we had massive inflation. The Fed raised the interest rates up to about 13 and 14%. The blue line represents the Fed increasing rates, but interesting enough, the stock market still went up 18% during that Fed hiking cycle. And you can see in these past hiking cycles, the stock market continued to go up until it reached a threshold point where the higher rates just collapsed the market. Here's a sample investing strategy if you wanted to individually pick your own sectors that had lower risk. If you wanted to still have some technology in your portfolio, then you could use the XLK technology sector and just invest in the amount that you feel is appropriate for your risk level. Keep in mind, each person needs to evaluate their own risk tolerance. I'm not saying sell all your stocks here and just buy staples. You need to look at your own particular situation and do what's best for you. I want to thank you for watching. If you have any questions, leave a comment. Stay tuned for our next update.